Welcome to the Bankless by Design podcast, where we rethink money, ditch the system, and rediscover what it means to truly thrive well. I'm Tricia Miller, mom of 7, financial coach, and founder of ThriveWell. Around here, we believe wealth is more than numbers. It's about freedom, stewardship, and building a legacy that lasts. If you're ready to challenge the norm and take back control of your financial life, you're in the right place. Hello, and welcome back to another episode of the Bankless by Design podcast. I hope that you're doing well today, and I am so thankful to have you with me. And today I want to address a trend that I often see, even with my own clients, more often than I would like, who are all excited in the beginning to become their own banker. And they pay their initial premium, and then very shortly thereafter, they fail to continue to pay their full premium or their PUAs, which stands for paid up additions. Or they start wondering how they're going to pay those additional premiums. They just can't figure it out. Even though we had a plan for that in our advisory meeting. And yet, rather than call me to have a conversation, more often than not, they just go radio silent. And I watch and I see that they're not paying their premium to the max. Well, when this happens, they're actually stunting the growth of their policy, and they're not really practicing the infinite banking concept. They merely have a policy. Good in and of itself, but it's not the infinite banking concept. And the more troubling part is that I suspect it won't be many months before they start wondering why they even got started in the first place. And they'll end up canceling their policies, concluding that this whole concept really didn't work anyways. Well, friends, this is why it is so important to keep listening to this podcast, to reread Nelson's book, Becoming Your Own Banker. You see, our minds have been programmed for years to think conventionally. It takes a lot of unlearning and rethinking our thinking before we can gain what my friend Joe DeFazio often coins as a state of being unconsciously competent with this process. If we don't keep rethinking our thinking, going back to it, getting our questions answered, investigating it again, we can so easily fall back into our default programming. I remember this distinctly myself. I'm not immune to this. I would study this concept. This is going back to the beginning. And I'd say to myself, okay, I think I've got it. And then the next week, I would turn around and say to myself, wait a minute, how does that really work? You see, the infinite banking concept is simple, but it isn't easy. And the most challenging part is unlearning that which we have been conditioned to think and to believe and to practice for years. So it isn't going to be undone overnight. And I can always tell the difference because the person who really is studying and grasping and understanding this is usually the person coming back to me saying, I'm not paying enough premium. But the person who doesn't really grasp this isn't paying their premium at all or just partially. At any rate, let me put this to you very simply. As a dear friend of mine, Bill Curtis, recently said, and I love this, you're already banking. You earn money. You pay your expenses. You pay your bills for the month. But where's your money? It's gone. Those dollars will never earn for you again. The bill is paid, but the money is gone forever. With IBC, there is only one small change that you must make. You have to learn to pay yourself first. You take that money, you put it in your policy as premium, which is now your banking system, a system that you own and control. And now when you need it, you take a loan against those cash values, and then you go pay the expense that you need to pay. Next month, you're going to earn an income again. Rinse and repeat until your premium is fully paid. The only difference is now, if something happens to you, you walk outside in front of a bus, your family is protected. The life insurance company is going to pay out a death benefit that far exceeds anything that you've paid into the policy. And there's one other difference, and that is that the money that you would have spent anyways is now going to continue to earn interest and dividends for the rest of your life, perpetually into the future, forever, guaranteed. Every single night you put your head on the pillow, the very next morning, those dollars will have earned interest. It can never go backwards. These dollars will be the only dollars that ever experience uninterrupted compounding available on planet Earth until you pass. That's it. That's it. So if that is true, why aren't you paying your premium to the full? Why are you paying your initial premium when you first start the policy and then months go by without you paying that additional PUA? We had a plan and something happened. Did you spend it? You have not grasped the concept. It's plain and simple. You need to reread Nelson's book. You need to book a call with your advisor. If I'm your advisor, book a call with me. Now, you'll say, but if I borrow money, I'll have an outstanding loan in the policy. Yes, you will. So what? You will now have a place to put more money. When you take it out of the commercial bank and spend it, you don't think you have to pay it back, but you should. You've just been brainwashed your whole life to think that you don't need to. Listen to Warren Buffett. It's not about how much money you make. It's how much you keep. So to all my friends out there who pride themselves on paying cash, this is so much harder for you to understand because you think you're saving money by paying cash. Listen, you finance everything you buy. There are no exceptions. If you borrow to pay for it, you're paying interest to a third-party bank. But if you pay cash, you are still paying interest. You're just losing the interest that you could have earned otherwise, and you will never see those dollars again. So ask yourself, this year, how much money did you make? How much of that money did you keep? If you didn't keep it, then you didn't really make it. It just flowed through your hands and right out the door. Even if you paid cash, and you may be a good saver. Good job. You have more discipline perhaps than the average bear. But the moment you spend those dollars, no matter where they are warehoused, except with the infinite banking concept, those dollars are gone. Even if it's a long-term savings for retirement, the minute you take those dollars out, they are gone. The compounding is interrupted, but not so with the infinite banking concept. All right. So back to my clients who are not fully paying their premiums or their PUAs. Maybe you're paying the base to keep the policy alive. Good for you. That's important. But if you're not first diverting those dollars into a policy and borrowing against it to pay for the things that you need in your life, don't fool yourself. You are not becoming your own banker. You just bought a whole life product with a death benefit. You are missing the boat. Each time you pay the PUAs that your policy has been designed to accept, you are buying little fully paid up blocks of death benefit. That's what PUA stands for. Paid up additional death benefit. But these are fully paid up at once. They're not something that is stretched out over time. So the minute you pay your PUA premium, you have a new block of death benefit that now is added on top of your initial death benefit so that it increases the overall death benefit inside your policy. Well, the cash values must rise to meet that death benefit by age 121. Further, those PUAs also produce dividends. And if your policy is properly designed for the infinite banking concept, those dividends buy more PUAs. Only this purchase of additional PUAs doesn't even come out of your own pocket. It came from the dividend that the previous PUAs earned. Now those PUAs also buy more death benefit, which earn more interest and more dividends, which buys more PUAs, which earns more interest and more dividends. And on it goes for the rest of your life. The sooner you pay your PUAs, the sooner this ever compounding effect goes into motion. The longer you put them off, because somehow you thought that you had to find extra dollars in your budget to pay your PUAs as if they were an additional bill, because you've been conditioned to think that loans are bad. Why would I want to do that? The longer it will be before you can get that flywheel started. Friends, this takes me to that very popular quote attributed to Albert Einstein, that compound interest, and I would add uninterrupted compound interest, is the eighth wonder of the world. He who doesn't understand it pays it, but he who understands it earns it. So if you have a paycheck coming this month, do just one thing. Divert it for a few days into your policy to pay premium. Then take a loan shortly thereafter and pay what you were going to pay anyways. It is one detour. That is all. And that detour will improve your future forever, because every dollar you can divert to premium first will be a dollar that will go to work for you forever. How many of your dollars do you want working for you anyways? I want as many as possible. Otherwise, you just have lots of cash flowing through your hands, landing on the books of somebody else's bank, and truly flying away from your life forever, making someone else rich. This is what happens when you fail to pay a premium first. Now, I'm going to keep this particular podcast short today because I want you to be able to put this episode on repeat. Listen to this over and over until it sinks in. Then give me a call. If you're a client, you have full access to me at any time for free of charge. I want my phone ringing off the hook. I will hold your hand until you get it, as long as you are making the effort to become your own banker. This is what I love to do. I am like a kid in the candy store when someone calls me and says, "Can you help me figure this out?" There is nothing I would rather do. So don't go radio silent. Make my phone ring off the hook. For those of you who are not my clients, maybe you're considering becoming your own banker. Maybe you're considering becoming my client. Go read Nelson Nash's book, Becoming Your Own Banker, and get yourself on my calendar. What have you got to lose? Nothing. But if you don't become your own banker, you do have thousands and thousands of dollars to lose to somebody else's bank. Let's get your money working for you, flowing back into a system that you own and control, flowing back to your own family or your own business working for you. One of the laws of gold in The Richest Man of Babylon is get those dollars working for you. And every time you spend cash, you fire those little worker bees. We don't want to fire those worker bees. We want those worker bees working for us forever. There's only two sources of income. It's either you working or your dollars working for you. I like my dollars working for me a whole lot better than me working. Okay, until next time, please like and subscribe, leave me a comment, and thank you so much for listening. Thanks for tuning in to the Bankless by Design podcast, where we're done with the system and we're doing money differently. Be sure to subscribe, share this episode with someone who needs it, and visit us at BanklessByDesign.com to learn how you can start living bankless by design.